start with a question that anybody could ask. It's a really easy question. Can anyone tell me what a company is? Okay, I'm guessing not. Let's make a really, really easy question. Can anyone tell me what money is? You're not unusual. I've given a talk roughly like this about half a dozen times a year for the last 7 or 8 years. I help teach on a Master of Research course at Imperial College called Medical Device Design and Entrepreneurship. And this talk is mostly stolen from one of my own talks called Your Place in Capitalism. The problem is that you guys are incredibly well educated. You're smart. You're interested in the world. But nobody ever gave you a lesson in how capitalism works. And you're expected to survive and thrive in this world of capitalism. Start-up companies, bank accounts, stocks and shares, being an entrepreneur, something like that. So right at the end of this slide deck, there's a kind of ask me anything slide. Do that, but there'll be a kind of clue as to the kind of things we're going to talk about. Now, obviously, we can't do the whole of capitalism in 50 minutes. But what I'm going to focus on is finance. The reason is that when you start up a company, as you'll see, getting money is one of the prerequisites. And to get money, you have to solve somebody's problem. What is the problem to which the solution is they invest? And if there's one thing I want you to take away from the next 40 minutes or so and memorize is you get what you want by solving somebody else's problem. Okay, let's get going. Lots of people are interested in being an entrepreneur. The course that I help out on at Imperial started also in 2014. In the first year, we started off with 40 people at the beginning of the term. We whittled down to about 20 by the end of them, or they had up. Now we have standing room only 120 people first lecture, because in that time, becoming an entrepreneur is a bit like becoming a rock star. People want to, tell the world that they're an entrepreneur. That's a cool thing. On the internet, there are various memes about what an entrepreneur is. This is one of the ones which is least like what it really is. This is the one that's most unlike what's going on. My mum doesn't think I'm marked up. Sort of my friends don't think I do nothing. Society doesn't think I spend my time on a yacht in the Mediterranean. For those of you who don't know, this is a still from a film called Wall Street in the 1980s, which is basically about ruthlessness and doing bad things to people. I don't spend all my time on equations, and I certainly don't wait for the phone. I'm on the phone calling other people. So at the end of the deck, there'll be a slightly better one of these, so something to look forward to, something that's a bit more realistic. So there's 4 key components to any startup, actually, not just life sciences. You need to have some intellectual property. Now, intellectual property, people think of patents, but they can be know-how, which is something that you keep secret. You know how to do something that you're not going to tell somebody else. It has pros and cons related to patents. Patents are published, so anybody can read it. Your trade secrets, as they call it, are private. But it can be copyright. It can be a design. You can do something called design registration. So if you design the shape of something, something like the Coca-Cola bottle or the Perrier bottle, they are registered designs. People cannot copy them, not because they're patented, but because they're registered. All of those things are important and they're necessary. You need people. A patent on its own is not going to get anywhere. When I started with Rajiv at the end of 2014, all we had was a bunch of patents. And we had to turn that into a business plan, raise money, turn it into an actual functioning business. You need money, obviously, and actually we're going to spend most of the time talking about how you get money. And here's the thing that holds everything together. You have to identify what's called an unmet need, a desire, a want. This can be that there is no treatment for ACLF. This can be that an investor has decided to invest in liver disease companies, but they don't have one they can find. So you come along and solve the problem. So we're coming back to that thing of you having to find the problem to which what you want is the solution. This quote, "The invention is the easy part," was said to me by an investor in 2007. Of course, it's pretty insulting to the inventors of things. But what the investor was saying is that there's a lot more to making a success of a company than the invention. There's a lot more than the patents. It's incredibly complicated. You'll end up talking to lawyers, you'll talk to accountants, you'll talk to regulatory experts, you'll talk to people who spend all their lives just pricing things, and so on. So you'll need to be able to talk to all of those people as well as inventing it. These are the companies that I've started. Obviously, Yakrit is here, Phagenesis is a medical device for the treatment of dysphagia, post-stroke, post-tracheotomy. It's a neurostimulation device, probably the first commercial example of a peripheral nerve stimulation with a CNS effect. It's quite a dramatic idea. Bioceramic Therapeutics was my first spin out from Imperial College back in 2006, which was a bone graft substitute that was doped with strontium, so it replaced the calcium in bones, made it stronger. And GenDAC, way back, 1999, was my first ever spin out. It's something called zinc finger proteins that are used to bind to transcription factors, switch on or off genes. So we won't go into any of those technologies unless you really want to. The unmet needs. What is the problem you're solving? Whose problem is it? You can do this kind of thing in real life. It doesn't have to be in entrepreneurship. It can be in answering the questions that I saw you guys were trying to answer earlier. What are we trying to get out of A-TANGO? All of those answers on there can be recast into which problem am I solving? Whose problem am I solving? And I think if you do that kind of exercise, you find you focus the answers very clearly. And I saw a couple of quite vague answers that I'm not sure what you would do to make them happen. So the central question in raising money is, how does an investor solve their problem by investing in you? Why would they do that? And to answer that question, we need to dive into the world of investment. We need to understand what their choices are and why they make those choices and who they are. There's a lot of cash in the world. Now, this is a long list of things. Company, I asked you what a company was at the beginning. The clue is in the word. In French, it's société. In German, it's Gesellschaft. So these are all society-type words. They're about groups of people. So a company is legally two or more people who get together to create a new legal thing, which has rights and obligations, with a goal in mind. That's a company. And legal structures create them in different ways. You can see various ones up there. If you have a language that I don't know, I'd love to know what the literal meaning of the word company in that language is. So think about, if you know languages that aren't Western European, I'd love to know what the literal meaning of the word company is in your language. So down this list, have a look at this list here, because at the end, we can go into any of these you want to, or anything else in finance. You've always wanted to know what traded options are, strangles and straddles and broken wing butterflies, that kind of thing, or hedge funds, or arbitrage. We can talk about any of those. So think about those. So money's everywhere. Where does it go? Let's have a look first at what this thing called cash is. On this one here, which is a British £10 note, it says, I promise to pay the bearer on demand the sum of £10. What does it mean, I promise to pay the bearer? It's, of course, £10 of silver. A long time ago, silver was worth a different amount from what it is now. So it was literally a promissory note. And in the longer version of this talk, I talk about how those promises originated in the Middle Ages. You were a goldsmith, for example, and you needed a place to store your bar of gold, and so you left it with the guild of goldsmiths, and they gave you a piece of paper that said you've left 100 grams of gold with us, and that piece of paper becomes a currency. The American one is even more interesting. It says, if you can't read it, this note is legal tender for all debts, public and private. Does anyone hazard a guess as what on earth that means? What does it mean to say this note is legal tender for all debts, public and private? Legal tender means a trader is obliged to take this. So, for example, at the moment you buy a newspaper, you get the newspaper, at that point you have a debt to the seller. If you hand over a £10 note or a $10 bill, the trader is legally obliged to accept that in exchange for the debt. So you can't do it with a Bitcoin. They are legally able to say, no thanks. So anybody who tells you that Bitcoin or crypto is somehow equivalent to legal tender, outside El Salvador, where it's been made legal tender, then they're lying. Okay, they're just crypto boosters. There's a great book, if you ever get a chance to read it, called Debt, the First 5,000 Years. It's much more interesting than it sounds. It basically postulates that debt preceded money. That in societies where there's just 200 people in your village, if you needed something, your neighbor would give it to you, and that would be a kind of debt. Money only arose when you had to deal with strangers. It kind of makes sense. It's a big fat book, so I've just summarized the first half. So cash is a kind of promise or a kind of obligation. But we all know that promises can be broken, and these are 3 banknotes from hyperinflation. Germany, Hungary, Zimbabwe, as recently as 14 years ago. So this is 100 billion marks. If anybody reads Hungarian, they can tell me it's in the Guinness Book of Records. The world's ever hyperinflation was Hungary in 1946. So this is some incredibly billions. This was only 14 years ago, Zimbabwe. This says $100 trillion on that banknote. See, even banknotes can become worthless. They're risky. The central thing about finance is about risk. Banknotes and cash are seen as the least risky thing, but they're not risk-free. And that's why everyone right now is getting very upset about inflation. People are prepared to take risks if you pay them. And this is where we really approach the world of investment. So this is a basic slide about risk and return. The next slide will be more complicated, and then that will begin to zoom in on being an entrepreneur and raising money in biotech. So cash is down here. It's not risk-free. You've seen what the risk is. It's called inflation. The price of cash, which is a strange concept, is the interest rate. So you can keep it in your pocket. Nothing happens to it. You can give it to a bank and you might get 0.5% or 1%. In Europe, you're getting 2% in America now. In other countries, you can get more. So the price of cash is the interest rate. Cash is considered the least risk. Then there's three other categories on here. Fixed interest means it's pretty similar to cash in some ways. It means you're lending money to somebody. They've agreed to pay you an interest rate, but it's usually not a bank. It's usually a government or a company. And they're called corporate bonds if it's a company, or US T-bills if it's the US government, or gilts if it's the UK. Property, shares. When you start a company, the day you start a company, there's one share and you own it. The rules say that as the owner of the one share, you can split that share into as many pieces as you want. So let's split them into 1 million pieces. And now you have 1 million shares. You still own them all, still have all the shares, but you can now take some of those shares and sell them to somebody. Or you can make the company create new shares and sell them to somebody. So let's do a little quiz here. Let's say somebody wants to invest 1 million euros in your company, and they buy half the company, and you have the other half. How much is the whole company worth?
Well, 2 million.
Yep, excellent. You're absolutely right. It's called the post-money valuation. The post-money valuation of the company, the value after the money has come in, is 2 million. What's the pre-money valuation of the company? What's the part of the company that isn't cash worth? So post-money, it's 2 million. Take away the cash, which was 1 million of cash, and you're left with 1 million. So the pre-money is 1 million. Who gave them the shares when they handed over 1 million, and who did they hand over that million to?
The owner of the share. So you,
Right. If that were the case, who would own that 1 million? So that can't be right, because the money is going into the company. Let's say I split my one share at the beginning into 1 million shares. If an investor comes in to put 1 million into the company, so the company has now issued 2 million shares, 1 million to you and 1 million to the investor.
So the investor defines the value of the company.
Yeah, exactly. I mean, in reality, there's a negotiation.
And the pre-money is also defined by the investor, not by the company itself.
Yeah, exactly. Exactly. You can say what you think it's worth, but on the VC side, when I was a VC, we literally take no notice of what the company says. We would make our own due diligence, we do our own valuation, and we come and say we're prepared to invest on the following terms. It can get much more complicated than that because there's a lot more to shares than just a percentage ownership. You can have rights of control, seats on the board of directors, and that kind of thing. But fundamentally, that's exactly right. The pre and the post money are only finalized at the point of the investment. So shares are pieces of company. Any ideas why property is more risky than debt? Property feels really low risk, doesn't it? The answer is something called illiquidity. Liquidity. If you buy property, if you buy a share today, if you go out today and you buy 100 Apple shares, you can sell them a second later if you change your mind, or tomorrow, or the next day, or next year, or whatever. You can't do that with property. So illiquidity makes property risky. In this case, it can even be more risky than shares, but it's not for other reasons. It's considered more risky than fixed interest. Okay, now we're going to look at a real slide. Sorry, it's a little more complicated, but it's worth beginning to go through these, and we can explain what any of them are if you want. But this is the world of the investor. So I'm going to jump ahead here a little bit and talk about pension funds, which I know sounds really, really, really boring. But pension funds are where most investment money comes from. So to get that money, you have to understand what problem you're solving, or what problem is being solved by the pension fund through investment. What is the job of a pension fund manager? What is the actual job? You have to know, because you're trying to get their money. How can you get their money unless you solve their problem? So what is the problem, the day-to-day problem of a pension fund manager? Imagine, that's your job. You're at a party, somebody says, what do? You say, I'm a pension fund manager. The job of a pension fund manager is to pay pensions. Pay the pensions of people who are already retired now. Pay the pensions of people who are retiring tomorrow. Pay the pensions of you guys when you retire in 40 years' time. So their job, and every month, they get a ton of money landing in other people's paychecks. Some of that goes to the pension. And so every month, they have to invest that money in a way that pays today's pensions, tomorrow's pensions, and pensions 50 years in the future. And every day between now, or every month. So what they do is they look at this and they say, where shall I put my money that solves that problem? So there's risk, there's time. They need to spread everything out so that they can do all of those things. So let's quickly work our way through some of these. Cash down at the bottom, TIPS, which is US Treasury thing that's basically cash-like. Short, intermediate, core, global, high yield bonds. Bonds are debt. Basically, short bond means time between now and when the bond pays out. Short, intermediate. High yield means high risk. That means there's a risk that the bond will not be repaid, the debt will not be repaid, which is why interest rates for, let's say, Greek government bonds are higher than interest rates are for Swiss government bonds, because people fear that Greece is less likely or more likely to default. Russian government bonds right now are very cheap. Over here we have hedge funds. Everyone knows about hedge funds, don't they? So a hedge fund is a fund that can do anything. Most funds will say, we're in bonds, we're in shares. A hedge fund can do anything. A hedge fund can buy works of art. They tend to specialize because they have to get money from people. They have to go out to people like pension funds and say, give us money because we're going to be a hedge fund that specializes in works of art. And that may or may not appeal to pension funds. But a hedge fund means that they can do long, which means buying something, and short, which means you're selling something. You can take a negative position. If I sell you shares in Apple today that I don't have, I could buy them back tomorrow. The market is trading. If the share price has fallen since then, I'll buy them back cheaper than I thought they would. That is taking a short position in Apple shares. So now we have what's called large cap, mid cap. These are sizes of the companies. Lower risk big companies, Apple, Microsoft, British Petroleum, all of those guys. In the US, they split these things into mega cap, large cap, mid cap, small cap, micro cap, and nano cap, something like that. Mega cap is something like $10 billion or higher. So you can see that these are very big companies that are considered somewhat less risky than middle-sized companies. Anyone want to tell me what the difference between growth and value is?
That's a bit complicated. So you've got growth stocks that are supposed to buy the stock relatively cheap, and you expect the growth to give you the return that you expect. Or you have value stocks where the goal is to buy something at the time of less value, but it will reach its value in the future. So you have to calculate the supposed value of the stock, hoping that it will actually.
Value stock is one that's already making money, plenty of money, that justifies its valuation. So typically there'd be things like utilities, electricity companies, water companies. People can't avoid buying those things, maybe even pharmaceuticals companies. You can't decide not to buy your anti-hypertension drug. It's going to be sold. Those are reliable companies, and they're called value because you can see the cash flow. Growth companies are ones that don't make money or make not enough money to justify their valuation. But it still is shocking to me how the BBC, the mainstream newspapers, still go around saying, isn't it amazing that a company that doesn't make a profit is worth 10 billion or 100 billion like Tesla? Because it's not about what happened, it's about what will happen. People are not buying history, they're buying the future. Okay, natural resources, pretty straightforward. Mining, so-called, there's precious metals, there's mining, there's so-called softs. And we've got small cap, and we've got international. Why is international so risky? So if you're investing in another currency, as well as all the normal risks, you're adding a risk currency. Emerging markets means non-developed countries. Alternative investments, that's where we are. Entrepreneurs and biotech. In fact, we're probably way off the top there. Anyway, so the bad news is that we're trying to get money from people, and we live up here, and they can go anywhere else they want. So getting money into our kind of business is quite hard. We have to offer a massive return to compensate for the risk. In my first venture capital company, we had a simple model. We assumed that we'd invest in 10 companies. 6 of them would go bust. 2 of them would return just what we put in, and the other 2 would return so much money they'd make up for all the other ones' failures and then double the money on top. And it's true that the easiest decision in investing in biotech or medtech is no, because most companies fail. Just fossil coin. If you are worried, you should be down easy. So that's the world we're talking to. Right? That's just circled around equities. So who are these individuals or institutions? It's changed over time. This is a slide I've looked up the figures for around now, and it's pretty much unchanged since 2009. What these numbers show is that people who invest used to be rich individuals, and now they're institutions. It's a simple story. Rich individuals are important, but there's institutions. So who are these institutions? And pension funds at the top. We'll talk about those in a minute. This says 20 times 10 to the $12 pension funds. The reason that pension funds are important is because they have so much money that they subcontract the investment. And that's very important to us because they subcontract a lot of the investment to specialists such as hedge funds, venture capital, which is our space, buyout, which is a different kind of venture, if you like. So let's just quickly walk through all of these. You know what a pension fund's job is: to pay today's salaries, next year's salaries, 50 years' salaries. How do we solve that problem? We help them understand that it's worth investing in something that will take 5, 10, 15 years to mature. That's okay. It's okay to take a long time. They need to solve that problem with time. You just have to remember that more time is more risk. And therefore you have to promise an even bigger upside. Which is why when CEOs and founders meet venture capitalists and they say things like, we need a 10 times return, they sound super greedy. The reality is that On average, they make about 2 times return over a period of 5 to 7 years, which in percentage per year terms is nothing special if you're taking risks. So you have to remember that it's going to feel greedy. These guys are going to feel rapacious, but having been on both sides of the fence, I know what it feels like when you see company after company you've invested in not make it. And that's just the statistics of the sector. Insurance companies. What's the insurance company's problem? Just out of interest. What does an insurance company do that isn't obvious? So the obvious bit is they insure you. But our chief financial officer, Sandeep Nanda, he worked in insurance for 25, 30 years. He didn't insure anybody. His job was take all those premiums that you pay now for the next year or whatever of insurance coverage and invest them. The real function of insurance companies is to invest premiums. They're getting all that cash up front. So they're important as investors, less important for us because their timelines are much shorter than for pension funds. Hedge funds we've discussed, sovereign wealth funds. These have become very popular recently. It's said that the Norwegian government investment fund owns 3% of every company in the world because they've invested all their oil revenues over the last 20 years and that kind of thing. There's a very big investor called SoftBank, ultimately Japanese owned. They have about $40 billion from the Saudi sovereign wealth fund. So they're very important. You'll never bump into them in your world, but just remember that. Family offices can be super important to us. Family offices have a different set of problems. What family offices mean is that a family or an individual that has built and sold a business now has a lot of money. What do they do with that money? Are they going to put it in the bank, own 1%, or are they going to try and do something active with it? They might even have interest in medical products for reasons that are not financial. That makes them super interesting to us. Doing good in the world can become important in the way that for venture capitalists, pension funds, they don't care. However much Rajiv and I want to save the lives of people with liver failure, that isn't going to solve the pension fund manager's problem of paying pensions. We could stop everybody in the world dying of liver disease and it wouldn't solve their problem. And they're VC subcontractors. They'll say nice things about how important it is to save lives, do good in the world, that kind of thing. But ultimately, we don't solve their problems by saving people's lives. That's not necessarily the case with family office. And our first investor, way back in 2015, he was a family office. He had a close relative who died of liver disease. I think, Rajiv, you treated that person. So family offices are relatively important to us in health as a source of money. They're independent from the pension funds. They sometimes have non-financial goals and therefore feel a little less uncomfortable in such a high-risk space. So we're almost at the end. So I want you to be thinking about any questions on the very last slide. So this was the one I found that was the least unlike what an entrepreneur is. If any of you are thinking of starting up a company or even joining a company. So, okay, my friends think I'm my own boss. My mum thinks I wear a suit and shake hands. Society thinks I invent stuff, but Rajiv invented it all, certainly not me. My boss, which is my board of directors, they want me to lead everybody else. This is what I think I do, and I really do, which is, it can be anything from, have we got travel insurance to go to us, through to, can we raise £20 million? And every spot in between. And this only happens occasionally, but more often than I'd like it. Okay, so the last slide is this one. So have a look if there's anything you want to ask about, or anything that's not on that list. My background is, as Rajiv said, I spent 10 years as a journalist on the Financial Times in the 1990s, mostly writing about the pharmaceuticals and biotech sector. But obviously, if you're on the FT for that length of time, you pick up a lot of other stuff as well. I spent 7 years in venture capital. I invested in companies in the US and continental Europe, was on board of directors of companies in California, on the East Coast, UK, France. And then I hopped over the fence, did 3 startups. This is your chance to plug the gap in any thoughts you might have about this world of finance, irrespective of whether you're going to start up something. Go ahead.
How come you changed from value investing to the entrepreneurship side? Was it worth it?
Yes, it was worth it. If you're a venture capitalist or an investor of any kind, you're only measured on one thing, the difference between a buying price and a selling. You know, if you make money, they don't care what else. If you lose money, they don't care what else. And in the end, it's a very soulless life. In this life, of course, it's important working with Rajiv, because every day you wake up, you treat our first patient on dialysis. It still sends shivers up my spine. Dialysis is a liver dialysis system. These patients are in ICU. They've got a very high chance of dying in the next few weeks. And the guy didn't die. And he walked out. Thought, this is just amazing. You never have that feeling as an investor. Being an investor is a very cold world. So it was worth it for all of that extra time, all those extra dimensions.
So if we should stop and go for a few drinks at the pool, and then we'll be back here with Thomas at 6:30. Thank you, Danny.
Thank you. It was a pleasure.